On paper, SaaS looks like the ultimate business model. You build the software once, sell it 1,000,000 times, and enjoy 80 gross margins. So why do over 80 of venture-backed software companies still burn through millions and go broke? The answer is not gross margin. The answer is unit economics. Software companies often boast 80 gross margins, yet many still burn cash and fail. It is not that the code is broken. It is that the customer math is broken. A product can look profitable on a margin report and still be a loss on the fully loaded customer ledger. A company can carry 1M in annual recurring revenue and a negative $500K cash balance at the same time. That gap is not a product failure. That gap is a unit economics failure. The revenue is real. The cash drain is also real. The only way to understand both is to look at the math under each customer. To understand if a SaaS business works at the single customer level, there are 4 foundational variables. The first is ARPU, average revenue per user. ARPU is how much a customer pays per month or per year. It is the starting point of the entire calculation. The second is CAC, customer acquisition cost. CAC is total sales and marketing spend divided by new customers acquired. It is the price of growth. It is also the number that many companies know only after the money is already gone. The third is gross margin. Gross margin is revenue minus direct hosting, payment processing, and third-party API costs. This is where cloud and AI costs first enter the model. A high gross margin means nothing if these direct costs are not actually under control. The fourth is churn rate. Churn rate is the percentage of customers who cancel each month. It is the leak in the bucket. Even a strong flow of new customers cannot hide a base that keeps canceling. When you combine ARPU, gross margin, and churn, you get LTV. LTV is lifetime value. LTV is the total gross profit a single customer generates before they leave. Those 3 variables work together. A high ARPU does not matter if churn is also high. A strong gross margin does not matter if the customer leaves quickly. LTV is where those forces meet. It is the real value of one customer, measured after direct costs, for as long as they stay. Investors and sustainable operators look at 2 non-negotiable ratios. The first is LTV to CAC. The target is at least 3 to 1. At that level, the gross profit from a customer is large enough relative to the cost of acquiring that customer. At 1 to 1, the company loses money on every customer after operational overhead. Growth does not solve that. Growth multiplies it. Every new customer extends the same loss across a larger base. The second ratio is CAC payback period. CAC payback period is how many months it takes to earn back the money spent acquiring a customer. For early-stage SaaS, the benchmark is under 12 months. The payback period matters because customers do not pay their acquisition cost up front. The company spends first and then waits for the customer to pay it back. If it takes 24 months to break even on a customer, the company requires massive capital reserves just to survive growth. The customer may eventually be profitable, but the cash has to be funded in the meantime. That is why payback period is a cash timing problem, not just a margin problem. So where does the money actually disappear? 4 places. Cloud and AI API costs. Unoptimized AWS GCP infrastructure or hyperquery LLM API costs eat straight into gross margin. Customer support scaling. Adding manual support staff faster than subscription revenue grows. The headcount goes up, the cost goes up, and the margin starts to crack. High sales friction. Long enterprise sales cycles require months of unpaid demos and custom integrations. A lot of work happens before the first dollar ever arrives. Net revenue retention below 100. If existing customers are not upgrading or expanding, the acquisition funnel has to constantly work twice as hard. The base is not compounding. It is just replacing what is leaking away. When the payback period is too long or LTV to CAC is low, the standard framework pulls 3 levers. The first lever is pricing and tiers. Most SaaS companies underprice. A pricing change does not require a new sales motion or a new product line. It changes the revenue per customer instantly. A 10 price increase often flows directly to net profit. The same customers, the same hosting, the same support, and more gross profit per account. The second lever is expansion revenue. Add-ons, extra seats, and usage upgrades for existing users. CAC for that revenue is near zero. The customer is already there. The only question is whether they can be expanded. The third lever is automated onboarding. The framework shifts from high-touch sales calls to self-serve, product-led growth, and that lowers CAC. If the product can bring a customer to value without a human in the loop, the cost of scale drops. Here is the whole math in one pass. There are 4 variables: ARPU, CAC, gross margin, and churn. There are 2 ratios, LTV to CAC and CAC payback period. There are 4 silent margin killers: cloud and AI API costs, support scaling, sales friction, and NRR below 100. There are 3 levers: pricing, expansion revenue, and automated onboarding. The targets are clear: LTV to CAC at least 3 to 1, payback under 12 months for early-stage SaaS, NRR at or above 100. The danger zones are just as clear: LTV to CAC at 1 to 1, payback at 24 months, NRR below 100. A company can hit an 80 gross margin and still fail one of these tests. That is the gap between a product that looks great and a business that lasts. Unit economics tell you the truth about your business long before the bank account does. If you want more breakdowns like this, subscribe to Thin Margins Co. for weekly business analyses. Drop a comment below with which company's economics we should break down next.